Some of the headlines. This is Democracy Now!, democracynow.org, The War and Peace Report. I'm Amy Goodman. As shareholders of JPMorgan gather in Tampa today, pressures growing on bank CEO Jamie Dimon over the bank lost at least $2 billion in risky derivatives trading. The New York Times reports Dimon and other bank executives repeatedly ignored warnings about the bank's risky bets. So far, 3 JPMorgan executives have resigned, including Ina Drew, the head of risk management at JPMorgan and the bank's chief investment officer. The loss has renewed calls for tougher regulation of Wall Street, with critics saying JPMorgan would have avoided the loss under regulations that it's opposed. Speaking to ABC's The View, President Obama said the JPMorgan crisis illustrates why Wall Street reform is essential.
JPMorgan is one of the best managed banks there is. Jamie Dimon, the head of it, is one of the smartest bankers we got. And they still lost $2 billion in counting, precisely because they were making bets in these derivative markets. We don't know all the details yet. It's going to be investigated. But this is why we passed Wall Street reform. This is the best, or one of the best managed banks.
Right.
You could have a bank that isn't as strong, isn't as profitable, making those same bets, and we might have had to step in. And that's exactly why Wall Street reform is so important. Now,
JPMorgan was among a number of large banks to lobby against the Volcker rule, which would prevent banks from certain kinds of risky trading. Speaking on NBC's Meet the Press, JPMorgan CEO Jamie Dimon says he expects increased scrutiny from regulators.
We've had audit, legal, risk, compliance, some of our best people looking at all of that. We know we were sloppy. We know we were stupid. We know there was bad judgment. We don't know if any of that's true yet. Now, of course, regulators should look at something like this. That's their job. So, we are totally open kimono with regulators, and they will come to their own conclusions. But we intend to fix it, learn from it, and be a better company when it's done.
Yeah. To discuss the implications of this latest Wall Street crisis, we go to Kansas City to speak with William Black, white-collar criminologist, former senior financial regulator, author of The Best Way to Rob a Bank is to Own One. He's also associate professor of economics and law at the University of Missouri, Kansas City. William Black, welcome to Democracy Now! Can you please explain what happened at JPMorgan?
Well, I can try. One of the things about this kind of derivatives is that it's extremely opaque, and we only have JPMorgan's side of the story at this point without any real investigation, and JPMorgan's story doesn't make a whole lot of sense. But here's what the story that they're telling is. They had about $15 billion in distressed European debt. As your listeners and viewers know, Europe has been in just a ton of trouble, and so those investments were losing all kinds of value. Now, the story, which again doesn't make a whole lot of sense, is that they decided to hedge this position. A hedge is something where you invest in a second asset that is supposed to offset losses that you suffer in the first asset. In this case, the first asset was that distressed European debt, and the second asset, the supposed hedge, was a derivative of a derivative. In this case, it was an index of credit default swaps, which are a form of derivative that blew up AIG. Now then the story gets even murkier, but the claim from out of JPMorgan is nobody was looking very carefully at this supposed hedge, and the hedge didn't perform to offset losses. Instead, it increased the losses and increased the losses dramatically, and supposedly no one was looking and no one adjusted for this, and they woke up and they had a $2 billion loss. So that's the story from JPMorgan. As I said, that doesn't make sense, and I can explain that if you wish.
Explain.
Okay, so first, if you have distressed European debt, you're supposed to have already reserved against the losses in it. So why hedge the position at all? Just sell it. Get rid of these incredibly risky assets before they can suffer any additional losses. If you've already got loss reserves, you don't even have to recognize a loss because you've already reserved for it. So you shouldn't have had to hedge, period. Second, if you were going to hedge, you should have hedged. And the way you would hedge something like this is to buy a credit default swap protection against the bad assets. That would hedge. In other words, if you lost on the value of the European debt, the credit default swap would go up in value and you would be protected against loss. Instead, they have allegedly bet in the opposite direction by buying this derivative of a derivative. If the European debt lost value, the derivative of the derivative was also likely to lose value. Well, that's not a hedge. That's a double speculation in the same direction. You're doubling down on the bet. And the reason you're calling it a hedge is because it's illegal under the Volcker rule to speculate in this fashion. So the story coming out of JP Morgan doesn't make any sense as a financial matter. It seems reasonably clear that this is faux hedges. This is, to hedging like truthiness is to truth. So this is hedginess. Not really a hedge, but you call it a hedge to evade the law.
I want to play more of what JPMorgan Chase Chair Jamie Dimon said this weekend on Meet the Press.
We support getting rid of too big to fail. And it's very important that, and this is not going to even remotely, we're going to make money, we've got tons of capital, but we support too big to fail. We want the government to be able to take down a big bank like JP Morgan, and it can be done. We think Dodd-Frank, which we supported parts of, gave the FDIC the authority to take down a big bank. And when it happens, I believe compensation should be clawed back, the board should be fired, the equity should be wiped out, and the bank should be dismantled, and the name should be buried in disgrace. That's what I believe. We need to put that back in the system, and we're working with the regulator to try to get that back in the system.
That's JPMorgan Chase Chair Jamie Dimon. William Black, your response.
Well, you can't have a system work the way he is saying. So if the institution is allowed to stay this large, it will be too big to fail, and its creditors will be bailed out. And that's to prevent what is feared to be a cascade of failures in which one big bank would then cause the failure of the next big bank, et cetera, and you'd have a global crisis. So allowing them to be this big, even conservative economists call this crony capitalism, and they say that it creates such a competitive advantage for the systemically dangerous institution, JP Morgan in this case, that it is the equivalent when they compete with smaller banks of, and I'm quoting, bringing a gun to a knife fight. So the only way this can work is to shrink the systemically dangerous institutions, this is the 20 largest banks in the United States, down to the point that they no longer pose a systemic risk. They are no longer too big to fail, and therefore they will no longer have this implicit federal subsidy that completely distorts competition. And of course, we're not just talking about destroying market systems. This also destroys democracy because these giant institutions have so much political power. And lastly, the statement is completely disingenuous because JP Morgan, in fact, opposes all efforts to get rid of too big to fail.
Speaking of democracy, JP Morgan's Jamie Dimon, speaking on Meet the Press, said he understands the anger of the American people with Wall Street. He's interviewed by David Gregory.
A lot of Americans are galled by the fact that the American worker is still struggling, and yet banks like yours are making a lot of money. Your compensation north of $20 million has been published in reports. Do you understand that frustration?
Sure. People have asked me what I do about Occupy Wall Street, and I've said that surprisingly, if the average American has the right to say that the institutions of America let me down, and that's true. And I think if the average American says that's predominantly Washington and Wall Street, broadly defined, I think that's true too. Washington and Wall Street, the epicenter, I blame both of them. I mean, there are a lot of policies and procedures. I think when you go beyond that and start to blame every single banker and every single politician, every single bank, no, it's not true. A lot of banks were a port in the storm. Not all the banks needed to be bailed out. A lot of them did things like Bear Stearns, WAMU, Wells Fargo bought Wachovia, and did everything to help. financing cities, states, hospitals. So that should be recognized too. So, but I understand that frustration. I understand the frustration in inequity. I think the world, we've become a little more inequitable. I don't think it's a good long-term thing for society, and therefore I'm in favor of progressive taxation. You know, you can get the specifics exactly.
The Buffett rule, for instance.
I don't understand the Buffett rule exactly, but if you said
more taxes on capital gains.
Believe it or not, I think most people on Wall Street would be happy to pay, to have the Bush tax cut go away and pay higher capital gains if they thought it was part of a plan to fix everything. I do believe that. And that's why, in effect, attacking is not the right thing, because they're willing to do their part. Matter of fact, I think you should appeal to people's better nature and say, listen, you're well paid. You've benefited from this great country. We need you to give a little bit more for now to help lift the country up. So anyway, I do understand the anger.
That's JPMorgan's Jamie Dimon. William Black, your response.
Well, first, they didn't make the world better off by acquiring Bear Stearns and Washington Mutual. They made themselves even more powerful and made it even more impossible to have them fail, and therefore vastly increased their political and their economic power. The proof of the pudding is what the big banks actually did, and the big banks lobbied to create the Gramm-Leach-Bliley Act, which repealed Glass-Steagall. Glass-Steagall had worked brilliantly. It separated commerce and investment, and it would have prohibited and prevented the losses that J.P. Morgan just suffered. They also, the big banks, pushed the Commodities Future Modernization Act. And if that act had not been passed, we would have avoided much of the entire financial crisis that we just went through, and we might well have avoided the $2 billion loss that J.P. Morgan has just suffered. The big banks fought tooth and nail and continue to fight tooth and nail to destroy the Volcker Rule, which, again, if the Volcker Rule had been in place with real regulations, would have prevented this loss. The big banks also fought tooth and nail the requirement that derivatives, when they did invest in them, that they do so in a transparent way through a clearinghouse, which also would have prevented this $2 billion loss. But that rule is not in effect because J.P. Morgan led the effort to delay the adoption of these rules and to weaken these rules so much that they're completely unenforceable.
Elizabeth Warren, who's running for Senate in Massachusetts, but was one of the shapers of the Consumer Financial Protection Bureau, has said Jamie Dimon should resign from his position as director of the New York Fed. Explain what that position is and why this is significant.
Yeah. The Federal Reserve banks, there are 12 of them regionally, have as their directors overwhelmingly industry. So these are overwhelmingly executives from the banks that they're supposed to regulate. Most regulation in the Federal Reserve is done through the field, through these regional Federal Reserve banks. So Timothy Geithner was supposed to be the top regulator in New York in his role as president. But no real regulation occurs, of course, because you can't expect people to regulate their bosses. It doesn't work. Congress recognized this in a completely analogous situation. In 1989, in the FREA legislation to deal with the savings and loan crisis, it looked at the Federal Home Loan Bank system, which was set up in a parallel way to the Federal Reserve banks. And it said, this is an impossible conflict of interest. You cannot regulate your bosses. And so it removed all governmental authority from the Federal Home Loan Banks. The same thing desperately needs to be done in the Federal Reserve, where it is far more damaging because these are much bigger players and much more destructive players. I mean, what we haven't mentioned to this point is why there is a Volcker Rule. And there is a Volcker Rule because it was these derivative positions that caused the global financial crisis. They caused hundreds of billions of dollars of losses to the largest banks. The list of systemically dangerous institutions that Jamie Dimon went through that failed. They all failed in large part because of these financial derivatives, what we call the green slime. So that's what brought down Fannie and Freddie and Lehman Brothers and Bear Stearns and Washington Mutual and Lehman, Merrill Lynch, and Wachovia. After those catastrophic disasters that caused the Great Recession, cost 6 million Americans their jobs directly, prevented another 5 to 8 million jobs from being created, helped lead to a global crisis called the Great Recession. After that, the banks still fought to be allowed to do exactly the same kind of derivative trades. And even when the Volcker Rule was adopted, over their opposition and over the opposition of the Federal Reserve and of Treasury Secretary Geithner, who remains true to his former boss, Jamie Dimon, after that they gutted the rule, at least the draft rule, to implement the Volcker Rule. And unless it is changed, the Volcker Rule will be essentially unenforceable, because you're allowed under the current draft to simply call something a hedge, even though it operates in the exact opposite of a hedge. And voila, this hedginess is okay, and the losses just mount up and produce the next disaster.
William Black, I wanted to end by asking you quickly about the economic crisis in Europe. In Spain, over 100,000 people took part in anti-austerity rallies Sunday. In Greece, anti-bailout parties won the nation's recent election. And in France, François Hollande was sworn in today as France's new president, becoming the first French socialist in power since the 90s. He recently said his enemy was the world of finance.
Mon véritable adversaire. Il n'a pas de nom.
My real enemy doesn't have a name, or a face, or a party. He'll never run as president, and so he'll never be elected, although he does govern.
Il gouverne. Cet adversaire.
My enemy is the world of finance.
That's François Hollande, France's new president. William Black, your final response.
Finance is supposed to simply be a middleman to help the real economy. It, in fact, now completely dominates and is a parasite on the real economy. German austerity has pushed the entire Eurozone into recession and the periphery into Great Depression-level unemployment. And the same arguments are being made in the United States and are used as a pretext to try to destroy Social Security, Medicare, and Medicaid. It is economically illiterate but politically attractive.
Your assessment of President Obama versus President Bush?
Well, less bad on this subject, but President Obama is also feels that he must politically say there's a vital need to balance the budget, which is to say to have austerity, even though he's looked at Europe and seen that the worst possible thing you can do in a Great Recession, or the attempted recovery from a Great Recession, is to start reducing the spending and such. And Obama needs to go back to what he originally proposed, which was brilliant. It was a Republican idea, revenue sharing. We all knew that the states and localities, unlike the federal government, cannot run significant deficits, and that there was going to be a financial holocaust that was going to reduce vital services and throw hundreds of thousands of public workers out of work when they were most needed, and exacerbate the Great Recession and dramatically slow the recovery. So the recovery bill, stimulus bill that President Obama proposed, had that provision. The Blue Dog Democrats, the conservative Democrats, and the Republicans got together to kill that, and unfortunately the Obama administration didn't fight for it. Here's what we know. The Wall Street Journal just ran an op-ed saying, don't allow the federal government to help the states. That tells you that's what they're scared of. It would be economically brilliant. It would be politically brilliant to bring back the revenue-sharing provisions, which are, after all, a Republican idea, and make the Republicans make the call that they want a financial holocaust throughout America, and they want us to slip back into a recession.
William Black, I want to thank you for being with us, author of The Best Way to Rob a Bank is to Own One, Associate Professor of Economics and Law at the University of Missouri, Kansas City, also a white-collar criminologist and former senior financial regulator. This is Democracy Now! Back in a minute.